Today's webinar is Credit and Building Wealth in the New Year. I'm Andrea Johnson. I'm the Grant and Financial Education Coordinator for the Office of Consumer Credit Commissioner. Today's webinar is for informational purposes only and does not constitute legal advice. A little bit of backstory on the Texas Office of Consumer Credit Commissioner for those of you who haven't attended one of these webinars. We license and regulate certain non-depository institutions, including pawn shops, payday loan lenders, and registered creditors. So we are scattered all over the great state of Texas in a variety of different ways. We also protect and safeguard consumers against abusive and deceptive practices, lending practices. And we educate consumers like yourself and creditors about your rights and responsibilities. Now, when it comes to those rights and responsibilities, if you need any assistance, if you want to talk about any of the places that we license or regulate, you can contact our consumer assistance helpline. Someone is standing by. They're also available just to kind of go over the fine print. You know, when you're filling out a credit card application or there's something you don't understand, go ahead and give them a call and someone is there to help you, okay? We provide financial education through me, the Financial Education Coordinator. We provide informational seminars and webinars. We used to do this in person, and I'm looking forward to that, to getting back out there, seeing everyone in person. We provide financial education materials like the handouts I have today, along with the ones we provide on occc.texas.gov. We provide public service announcements and press releases regarding our financial education and our grant program. And our grant program is where we partner with other education-oriented organizations. The Texas Financial Education Endowment, which I'm responsible for helping to manage, partners with organizations across the state of Texas, the entire state of Texas. We're always looking for new organizations that provide financial education for K through 12, adults, and financial coaching for low or no cost. So if you know any organizations, if you have a friend, a family member, someone you know that works for an organization that could benefit from that, please let them know. The grant cycle is going to start up again very soon. And this includes, you know, current recipients are the Girl Scouts, Family Elder Care here in Austin. We have a place in El Paso. There's just organizations all across the state. So if you can think of anything, anyone that would be interested, you know, we've done funding for Goodwill also, you know, but they've got to be Texas based, and just let them know, okay? Credit and building wealth in the new year. Again, this webinar is for informational purposes only and does not constitute legal advice. New Year's resolutions. Yes, we're approaching the end of January, and hopefully by now, if you have any New Year's resolutions, you've already kind of written those down and made a list. Looking at this list, exercise, lose weight, get organized, learn a new skill or hobby, live life to the fullest, and right there in the middle, save money, spend less. Money and financial matters always winds up on a resolution list, because if you look at the rest of the list, a lot of these things are going to be tied to money. Let's say you want to go on vacation. Well, you got to have money to afford that vacation. You want to, you know, learn a new skill or hobby. Well, unless it's yodeling, you're going to need an instrument. You're going to need the yarn. You know, if you're going to take up knitting or crocheting, you're going to need all these things. So even losing weight, you're probably going to need, or exercising more, you're probably going to need a new pair of tennis shoes. That takes money. So it's going to take a budget. It's going to take possibly looking at your credit. And I talk about New Year's resolutions because when it comes to your finances, in order to achieve your New Year's resolutions and in order to achieve your financial goals, they're very similar. You need to prepare. You need to set goals. You need to make them manageable goals, and you need to communicate them with not only yourself by writing them down, but by sharing them with other people. And don't be too hard on yourself. It's the same thing. So when you are working on your New Year's resolutions like I am. I have a big birthday coming in December, and I'm really trying to get healthier before that happens. But financial stuff is always on that list. And so your financial goals, your credit, those have the same path, so to speak, I guess. And always remember, don't be too hard on yourself, because there's going to be setbacks. There's going to be setbacks with your New Year's resolutions. You know, I had a big lunch yesterday and it was delicious, and I paid the price for it. But when it comes to money, it's the same thing. You're going to have that aging pet. We had a few aging pets. It was a setback. So if you have any New Year's resolutions, go ahead and drop those in the chat box. I'll mention those to the group if you want to share them, and just kind of get everybody kind of thinking and on the same page. But today, what is credit and why do you need it? Credit gives you the financial power to qualify to borrow money or pay for goods and services over time. And you might be thinking, well, yeah, I already know that. But goods and services includes a lot of different things. Good credit also covers you getting a good job, renting an apartment, financing a car, getting a loan, spreading out payments, phone service, credit cards, qualifying for insurance. And you might be thinking, well, yeah, of course, all of those things. But depending on whether or not you have good or bad credit, the things on this list could be different for you versus someone else. So what's the difference between good and bad credit as far as a creditor is looking at it? Well, a good credit means that you're reliable in paying your bills on time. Companies will be willing to extend credit to you, and they might offer you lower pricing. Bad credit, on the other hand, whether or not this is true for you, lenders could see bad credit as you being unreliable in paying your bills on time, high debt to credit ratio, your bills are paid late, your debts have been abandoned, and you've filed for bankruptcy. So how do lenders determine your credit worthiness? Creditors are going to be looking typically at the 3 C's: your character, capacity, and your capital. Your character is how you've handled past debt obligations. You know, they look at your credit report and they go, oh, okay, they don't have any charge-offs, they don't have any liens, they've taken care of everything. Capacity is how much debt you can borrow comfortably. So they're going to be looking at your debt to income ratio. If your debt is really high and you're chunking away a lot of your income towards paying down that debt every month, the likelihood of someone lending money to you is going to be pretty low, unless it's a lot of times places that charge a very high interest rate. Capital. What are your current assets? And this includes any money you have in a savings account, any investments, real estate, your home, those things that can be used to repay debts if you can't. Your debt to income ratio. This is a really big one. I really advocate for you to really work on your debt to income ratio in order to increase your credit and to increase your consumer confidence too. That's another thing having good credit, having a good financial picture will help you with. So this measures your current financial obligations against your current income. 10% or less and you're in great shape. 11 to 20%, you shouldn't have any trouble getting loans, but you are creeping up there. When you get to 21 to 35%, you want to stop charging. You probably aren't having trouble getting new credit cards, but you're probably spending too much of your income to pay down debt. And the reason why you're probably not having a problem getting credit cards is I always felt like when I was really applying for all these credit cards back in the day, I felt like people looked at me as almost a target. Like, ooh, she's got a lot of credit cards, let's give her another one. Now, when you get to 36 to 50% of you need to work on a plan to get out of debt when you get to 36 to 50%, because you're paying way too much on your debt versus what you've got coming in. And that's gonna, sadly enough, it can become cyclical in the sense that your debt is so high, now you are reaching for that credit card to help make ends meet. So it's just, a double-edged sword at that point. What are credit reporting agencies? A credit reporting agency is a clearinghouse of consumer credit information that is simply to maintain and compile information by you and your creditors into a report. Your role, though, is to establish your credit and check your credit file with the credit reporting agency for accuracy, and do it at least once a year. So here's a few other things you need to know, just a background about credit and under the Fair Credit. Oh, I see someone is calling in from Pflugerville. I lived in Pflugerville. I loved living in Pflugerville. I lived there for many years. Hi, Pflugerville. So when it comes to the Fair Credit Reporting Act, I can say that today, you are entitled to a free and accurate credit report. Under the Free Credit Report, under the Equal Credit Opportunity Act, it prohibits credit discrimination on the basis of race, color, religion, national origin, sex, marital status, age, or because you get public assistance. The Credit Repair Organizations Act prohibits untrue or misleading representations and requires certain affirmative disclosures in the offering of sale or credit repair services. This act bars companies from offering credit repair services or from demanding advance payment. It requires that credit repair contracts be in writing and gives consumers certain contract cancellation rights. So even if you agree to a credit repair organization, credit repair organization's terms, you signed all the paperwork, there are contract cancellation rights that you have. You know, if that's something you're dealing with right now, you thought it'd be a great way to pay off your debt, get things taken care of, and you sign up for a credit repair, sign up with a credit repair organization. Sorry about that. There are rights, and there's rights for you, and you can call us. You can call the Office of Consumer Credit Commissioner, and they can go over those with you. It also needs to be in writing. Several years ago, way back in the day, I agreed to what was a consolidated loan, and I did not realize that I did it all over the phone. I was young, I wasn't thinking, and I wanted to consolidate 2 credit cards. And it turned out that when I consolidated for, I think it was either called a consolidated loan or consolidated line of credit, it automatically, based on what it was, gave it the highest interest rate possible. Regardless of my credit score, regardless of my credit history, it automatically had the highest interest rate. And had I known, 10, 15 years ago what I was getting into, especially because I did it over the phone. I agreed to this over the phone from a company that I already had a credit card with. And that's one decision that I regret doing. So how often, I've got some questions today. How often do you check your credit report? Are you checking your credit report at least once a year, twice a year, more than twice a year, or have you never checked your credit report? And I'm going to talk to those nevers in a second because we want to change that. If you're checking it at least once a year, you're on a great roll. At least once a year is good. Twice a year is even better. More than twice a year. And then you've got the nevers. So let's close this and see how everyone is stacking up today. I am a more than twice a year person. And as you can see, 29% say once a year, 7% say twice a year, 21% say more than twice a year, and those 43% say never. And I will tell you that one thing I've had, and see, someone just posted it. Someone said, I'm afraid to check my credit report. Do not be afraid. Go to annualcreditreport.com and check it. Check it at least once a year. Because here's the thing, checking your credit report does not affect your credit score. And that is a misconception that I hear a lot during this webinar is, will it affect my credit score? And it doesn't. And we'll talk about that coming up in a second. There are 3 credit reporting bureaus, and they do not make lending decisions. They only maintain and compile information in a credit report for you and for companies that need to view it and employers that need to view it. And if something is incorrect, you need to dispute it with the creditor and the credit bureau. You need to get it taken care of. And you are entitled to one free credit report a year. Right now, I know last year during 2020, the pandemic, I think it was once a week they were allowing, it was either once a week or once a month, they were allowing people to check their credit report for free because there were so many scams going around. There's so much fraud going around surrounding the pandemic. So they gave that as an opportunity. And I don't know if that has stopped yet as we've gotten into a new year, but you can still go to annualcreditreport.com and get your free credit report, and I advise you to do that. So what's in a credit report? Your personal identifying information, your account information, your public record information, and any inquiries that you've had. Also, what's not in a credit report is your race, religion, lifestyle, medical history, political preference, and criminal record. Someone in the chat box today said, I don't check my credit report because I haven't used credit cards for about 2 years. Well, if you'll notice, your credit report also has this other information in it. It has your personal identification information. It has your account information, and that's accounts for car loans, mortgages, any type of loan you might have. It has public record information and any inquiries. So maybe you've got people out there, creditors that are just, maybe you logged onto a website and somebody ran your credit that you don't know about. Maybe you've got some last names in there that are incorrect. Your credit report not only is going to give you insight into what your credit score is and what your credit history is, it's going to also give you insight into whether or not you've been the victim of identity theft. So, what if wrong addresses are on there? What if, you apply for a job and they say, list all your addresses that you have. They check it against different records. And there's some address on your credit file that you never lived at because somebody had put that incorrect information on your file. So that's something you need to address. And since it's free to check your credit report and it doesn't affect your credit score, it makes sense to just check it at least once a year, just so you can make sure that the information is correct and that someone there's something fraudulent out there that you need to take care of. Now, when we talk about your credit report, you also think about your credit score. So in order to increase your credit score, there's certain things you need to think about. How long is your credit history? Because the longer it is, the better. What is your debt to credit limit ratio, which we just talked about? So the lower it is, the better. So if you're in that 10% or less category when it comes to debt versus your income, you're doing great. How many inquiries do you have? The less you have, the better. And we're going to talk about inquiries. Do you pay your bills on time? If you're doing that, you don't have any charged off debts, that's going to help you with your credit score. Are there any charged off accounts, judgments, or bankruptcies? And, people will look at these. If you think about it, it also depends on what you're applying for. If you had a car repoed, more than one car repossessed, then of course, when someone is, wanting to lend you money to purchase a vehicle, they're going to look at that differently. If you've had an eviction because you didn't pay your rent or foreclosure, that's going to also weigh in when you're doing that process. So there's different things that will come up, and they're going to take that into account. And I've got a few questions in the chat box, and I'm going to mention those just after I get done reading this real quick. Credit scores typically range from 350 to 850, and the higher the score, the easier it will be. A great, excellent credit score is 750 or above. One of the questions that I have is, if we find something that is not correct, how can we get it taken off or fixed? I'm going to talk about that in a second. You can talk about, I'm going to go over the whole dispute process. Actually, when I logged on to Experian's website, I think it was, one day just to randomly see about checking my credit before I did one of these webinars, and they actually have right there on the website a dispute process link, and you fill out the information and go forward. So you got to pull your credit report, see what's on there, and then you follow the process. And how does freezing and unfreezing work when it comes to your credit report? I'm going to talk about that in a second too, so hang on with me, okay? There are different types of credit scores. There's Beacon, FICO, and Vantage. FICO is the one that is most widely used and the one you're going to see the most. It ranges from 350 to 850. A score of 670 or above is considered good. And then I believe 750 and higher is considered exceptional. I actually have a back and forth. My husband doesn't know this, but I will check our credit reports and credit scores and always want to make sure mine's a little higher than his. It's my own personal competition, but you know, he doesn't need to know. Managing your credit inquiries. The fewer the inquiries, the better. Only apply for credit when you need it. When you apply for a mortgage or loan, do your shopping in a short time frame and regularly check your credit report. Credit inquiries stay on your credit for 2 years. And there are two different kinds. There's a hard and a soft inquiry. A hard inquiry is when a lender reviews your credit report to make a decision on mortgage, auto, credit card. It's considered hard because it's tied to an application and it can affect your credit score. Now, when you check your credit report or when a lender checks for pre-approval, that is a soft inquiry, and soft inquiries do not impact your credit scores. So the big takeaway from these two things that always stand out to me is a hard inquiry involves an actual application, where pre-approval is, you know, you get those offers in the mail or you get emails that say you've been pre-approved for this Chase card, this Capital One, Bank of America. You know, the list goes on and on and on. There's so many out there. That pre-approval letter doesn't affect you. It's when you fill it out, that attached application, and send it back, that there's now been an inquiry on your credit. And that's a hard inquiry, and that will affect your credit score. So don't just apply for every credit card offer that comes along. So is it good to have several inquiries? And I think I just accidentally answered my own question. I sure did. I just said the answer to this question. This is to make sure you're all paying attention and you're still awake this morning and you're hanging in there with me. So when it comes to your credit inquiries, the answer is no. It is not a good idea to have a lot of credit inquiries because they drag down your credit score. So now that we talked about inquiries, and I hope I'm not rushing along this morning too quickly. I feel pretty charged up about today. Let's talk about disputing inaccuracies. If you discover any inaccuracies on your credit report, you need to complete the request for reinvestigation, and that is actually, I think that's exactly what I saw on Experian's website that day. Right there, it's a little form you just pull out and grab. Or you can send a letter listing each incorrect item and explain exactly what is wrong. Today, everything is online almost, so this is the first step. Well, the first step is checking your credit report to make sure everything's accurate. If an investigation does not resolve your dispute, you can add a statement to your file of 100 words or less and contact the creditor. And here is the step-by-step what this looks like, okay? So first you get your credit report and you notice that there's something wrong, okay? You want to dispute the inaccurate account with the credit bureau. So, you know, Experian, TransUnion, Equifax. The credit bureau will check the creditor to verify the information. The creditor has 30 days to investigate and respond to the bureau. If the creditor doesn't respond, the information must be removed. So it could be as easy as this. It could be as easy as finding the mistake, contacting the credit bureau, they contact the creditor doesn't respond in 30 days, and boom, it's gone. And that inaccurate information is off of your credit report. Now, if the creditor does respond, then the item will either be deleted or verified. So if they check it and they go, oh yeah, that's incorrect, it'll be taken off. But if they check it and it's supposed to be there, because you keep in mind, a lot of debts have time on them. You know, inquiries 2 years, bankruptcies 7 to 11 years, depending on how you file. A new copy of your credit report will then be sent to you, and you're entitled to a statement of no more than 100 words to explain any negative remarks on your credit report. So the best thing to do, someone wants to know, does it matter which bureau you use to dispute inaccurate information? I do not recommend one over the other. That's going to be almost, you know, go to their website and see, well, when you pull your credit report, you're going to see, you know, I use an app that tells me, I think it's Experian and TransUnion. I think those are the two that's on there, but I don't see Equifax. And so it shows me what the two, you know, I think my credit score is. It shows me what, so I would dispute it with where it's popping up. You know, if one has it and one doesn't, that's who I would go with. It doesn't really matter. It might just be a matter of, is it more user friendly on one organization's website versus the other? You know, if you go to Experian's website, it's really easy to navigate to get the information you need, or you like the layout of TransUnion or Equifax. So that just might be how you kind of determine that, because it's going to be a pretty easy process to just, you know, most of them have a form, you just fill it out, call it a day, and you wait. And that is one of the catches here. If you notice, it says 30 days. I always like to point out, when it comes to the dispute process, it's like shopping. You know, you go to the store, you purchase whatever you need, whatever you want, and then you return it. Well, when you were standing in the store, if you looked at your bank account through your, you know, app on your phone, you'll see that the money was taken out immediately almost. At least it's pending, but that return is going to take as long as it's going to take. And so the dispute process is the same thing. See, the creditor has 30 days. And you want to, if you have multiple things in your credit report, I also want to point that out. You tackle one thing at a time. Don't try to tackle everything. Is it possible that I would find different information on the 3 different agencies? That I'll have to double check. I don't believe so. It should be pretty much the same across the board, but I would definitely, I'll verify that and double check on that to just kind of get a better feel for it. And I can even email you the answer to that one, but they should be pretty much the same, because they're all, hopefully, they're all going off of your information. They're going off of your social, your addresses, your name, your date of birth. So it should all be the same information. And that's where, you know, like I mentioned, I use an app that shows me both, at least my credit scores. And so that's helpful to kind of help navigate that area. Let's make sure I'm not forgetting things. And hopefully this answered the question of getting something taken off or getting it fixed. I hope that helped. So what can be changed? Information that is incorrect, such as accounts that are not yours. It's gonna, well, names. If you have a wrong last name on there, you know, if you have addresses that are wrong, if you have incorrect payment history, but you will need to show proof of that. And any old information that can be changed. What cannot be changed is information that is true. And that includes inquiries, information within legal timelines. That's the big one. So that includes those public records, that includes history of payments, and that includes your accurate credit inquiries. All of those things have certain time parameters that they can just sit there. Like I mentioned bankruptcies, for instance, because that's a pretty well-known thing. Your bankruptcy, if you, depending on how you file, 7 to 11 years. So if you're 5 years into your bankruptcy and you go to check your credit report and you go, oh, why is this bankruptcy still on here? Well, because it's allowed to be for 7 to 11 years, depending on how you file. And I have just so you know, I have a second screen right here. That's where my question box is. So if you're seeing me look over here and go, oh, she keeps looking away, that's what I'm looking at, is that right there, your questions and answers. So that question about a freeze, let's talk about freezes and frauds and fraud alerts. Should you place a freeze or fraud alert on your credit report? A freeze generally stops all access to your credit report, all access. It's available to anyone and it's temporary until you remove it. That's the difference. You have to remove it. A fraud alert, a business must verify your identity before issuing credit. It remains in effect for only 90 days. To place a fraud or freeze alert on your credit, you must contact at least one of the 3 major credit reporting agencies by phone or online. Nowadays, everything's online. I'd probably do it online. Sorry about that. Recently, I met someone who has a freeze on their credit report, and they've had it for years. They keep it there. She and her husband just keep it on there because they had a whole bunch of credit cards coming to their house, and these weren't applications or pre-approvals. They were credit cards but in their name that neither one of them had applied for. And it turned out that someone had been applying for these credit cards, and so some were coming to their house, but then others, you know, they were kind of checking to see if oh, okay. You stated that a freeze freezes access to your credit report. Did I say? Oh, sorry about that. Here, let me clarify. I need to fix this. I'm glad you asked that question. It freezes your credit. Yes. I need to fix that. It freezes your credit because it freezes okay. Well, I guess no. It does freeze your credit report because if you think about it, what happens is when you apply for a credit card, the organization, the business, the lender goes to look at your credit report in order to verify that you qualify for the credit card, the loan, whatever it is. If they don't have access to your credit report, they cannot verify your credit information. Therefore, they cannot issue you a credit card, a loan, or whatever that financial item is that you're applying for. So that's why it's a freeze on your credit report, because they can't get into it. They can't see it. And therefore you can't get that credit card. That goes to the woman who she always has a credit freeze on her credit report, because when she goes and she goes, oh, I want the 70%, I want the 20% off if I buy this item, and I just need the credit card. Apply for this company's credit card and get this. So in order for her to do that, she would have to contact the credit bureau, remove the freeze, and then she would be able to apply for the credit card. Because what's going to happen, since the credit report is frozen, the creditor cannot see it and they cannot give her credit. See how that I see where the question came from and why that would be a little confusing, because yeah, the credit report is frozen. You can see the information. You can go and see their information. The creditors can't. And so by doing that, you can't get credit. I hope that makes sense. No, you do not have to unfreeze your credit report to get, as far as I know, I'm going to double check on that. I haven't had that question yet. You shouldn't have to unfreeze it in order to get a credit report, because that information is coming from the Credit Reporting Bureau, and it's not you're the one requesting the information. So yes, no, you don't have to unfreeze it because you're requesting the information, not a creditor. It's your personal information. You have the right to see that information. It's like your medical records. You have the right to see your own medical records and to know what is wrong with you. So you have the right to see your own credit report to know whether or not anything is wrong with it. So that doesn't affect the freeze or the fraud alert because you're the one trying to get the information, not a creditor. Keeping your credit in check. So here's a few things you should be doing already. If you're not, you need to live within your income. It's a basic rule of sound money management. Don't try not to exceed your income. Some months you're going to have some shortfalls. You're going to whip out your credit card. You're going to use your credit card. Cut down on your impulse spending because that can lead to financial problems. This was probably my biggest problem. When I first moved out on my own, I thought I was, amazing, not living with my parents, had some credit cards. I had a shoe problem, I admit, and I would think nothing of, oh, those shoes are really cute. Swipe. Who knows how much money I spent on shoes when I was in my 20s, and they're adorable. And some of them I still have. I can't let go of them, and I really should, Marie Kondo my shoe closet. But I haven't. So that's the thing. Impulse spending. Oh, that was a big one for me. If your expenses exceed your income, you have three choices. You can increase your income, or you can reduce your expenses, or you can go into debt. We don't want to do any of those. Well, maybe to increase your income, that would be nice. If your income exceeds your expenses, the extra money can be added to your savings or used for other purposes, such as paying down debt. For instance, you get a promotion or a raise at work, regardless of what that money is. Maybe it's $20, $50 every paycheck, whatever the difference is. I know we've got some state employees on here today, and there's longevity. So the longer you work for the state, you get a little, I don't know, a little something. And so it's not a lot, but that could go into a savings account. That's always a good one. The years of service. So that could be something you could add into a savings account or put that towards paying down debt. Now, one of the things I also want to talk about, we're still talking about credit today, is reestablishing your credit. By reestablishing your credit, we're also talking about stability when it comes to employment and payments and your residence. So staying in the same place for a longer amount of time, living in the same home, not constantly packing up and moving every year, that will help you to increase your credit and help you work towards having better credit. And remember, it takes time. You got to be patient with these things. As we mentioned, inquiries stay on your credit for a pretty long time, depending on what they are, bankruptcies, credit card applications, loans, things like that. You can apply for a secured account, like a loan or a credit card secured by a small savings account. These are great. That's great for someone who has no credit history. If you've got a high schooler, for instance, that's going to be going to college soon, and they have no credit history, and they're going to be looking for their own apartment soon. A secured account like a credit card or a loan would be great, because that's going to be relying on money in a savings account that's attached to the card. So that way the lender knows that the money is there to take care of it. And so that's a good start for that person to build your credit. And that would be good for anyone, especially if you've got bad credit. That would be good for you to help reestablish your credit. Now, maybe you've already thought about this. You want to consider the pros and cons of debt settlements. Right now, of course, we're in the month of January, and like we mentioned at the beginning, New Year's resolutions. So what are we seeing? We are seeing a lot of commercials about getting out of debt because they know that financial matters are in the top 10 New Year's resolutions list. One pro is that a debt settlement may help you pay off your debt for much less than you owe. That's good. But on the other side, it will impact your credit, and it could be on there for quite a while. It's going to depend on the terms and the contract and all of that stuff, and how much debt you have and what you're settling, and it's just a whole list of things. So you really want to think about that, because yes, getting out of the debt, if you have a high debt, you know, a lot of credit cards, high balances on them, that might be a really good idea because you're going to put those in one little basket and take care of it. So one thing about credit, one thing about your finances is debt repayment. So does using your debit card as a credit card on purchases help your credit history? As far as what I understand about debit versus credit cards is, well, you know, when you're at the store and it says, do you want to use it as a credit card? It's still coming out of your checking account. It has to do with the security of how you're using the card. When you swipe as a debit, you have to use a PIN. You have to use something that's linking you to, you know, you have a PIN number, or you have to enter, like, I think, oh, a credit card, maybe you have to enter your zip code, but it's still the same way. It's just the security as how it's, I guess, clearing through your bank, if that makes sense. Because it's still your debit card. A credit card is separate because the credit card, now a secured credit card, of course, is attached to a savings account or some kind of account, and that's different, but that's a secured credit card. Your debit card, when you use it at credit, that has to do more with like the security features and how it's going to be processed. I've noticed that if you use the debit card, thanks. I've noticed when you use it as a debit card, it's instant. If you swipe as a credit card, sometimes there's going to be like a gas pump. You might see $1 hold on the card because there's extra little, I guess, security walls it has to go through. So it'll put a temporary hold on it and then process later. But it's still coming out of your bank account. It's still a debit card. So yes, it is different, but it's not going to help your credit history to use your debit card as a credit card. So debt repayment, debt snowball. When it comes to debt snowball, you're going to pay the minimum payment on everything, and any extra goes to the smallest balance. So regardless of any cards that have higher interest rates, regardless of the interest rate, let's say you've got a card that has a $200 balance and has a really great interest rate, and you get a card that's got a $500 balance and a really horrible interest rate. You're just going to pay the minimum on that other one, regardless of the interest rate, even though the interest rate, you know, makes for interest charges every month that are higher. You're going to pay off the smaller one and get it done. To me, this feels better because it's quick, it's painless. Like, oh, I've got an extra $200 this month. Done. Card's gone. And then you can focus on the others. The debt avalanche is the opposite. You're going to pay the minimum payment on everything, and anything extra goes to the highest interest rate. This is going to attack those high interest charges. So that's going to help work on getting, for one, the balance down. But as you're getting that balance down, those interest charges are going to go down as well. But that's just because, you know, the interest charge is based on the balance that the credit card is holding. So consolidate your credit cards and consider balance transfers, but watch for fees. I like to mention that when you are looking at this, or you're thinking about it, I know I've seen a few that say 12 months, no interest, 18 months, no interest, whatever, for consolidating your credit cards. If you are consolidating such an amount of money that is so high that at the end of those 12 months, or whatever the zero interest rate is, or the low interest rate, you know, the introductory rate, if at the end of those 12 months, you will not have that debt paid off, you're in the same boat you were in before you consolidated. So really think about that. You might want to look at the debt snowball or the debt avalanche way of hitting at these debts that you have instead of consolidating, because yeah, it looks good. It sounds good on paper, but if at the end of that term you still have debt, you're going to wind up in the same place you were. If you haven't already, one of the things you need to do with debt repayment is stop using credit cards or other debt to finance living expenses. This means when the end of the month comes and you've run out of money, Try not to whip out that credit card. Build a budget, see where you had a little boo-boo during the month, and is that constantly happening? Are you constantly pulling out the credit card because maybe you spent too much on eating out, maybe you spent too much on shopping, maybe you had some unforeseen car expense that you didn't know about it, but you had to use it because you don't have a savings account. You don't have any money set aside for those rainy days. Really try to get away from that, because that is just going to keep going. It's going to be this cycle that you're not ever going to be able to get out of if you don't nip it in the bud. Allocate extra money to debt repayment. And allocating extra money to debt repayment sounds great, but what this means to me is when you get a little extra, whether it's $20, $10, you know what you could do? Let's say you get a little bit of cash. Maybe you sold something. Put that in an envelope. Don't put it in an account that you use. Just kind of set it aside, and then, before you're about to make your payment online, probably, put it in the account, transfer the money, call it a day. That's one thing you could do when you get extra money. You could also set up, I have a separate savings account from what I call our working account. Our working account is the one our paychecks go into. It's the one our bills come out of. It's the one I do the grocery shopping and, make the car expenses like gasoline and all that other stuff. That's my working account. My savings account, I have something set up and it just automatically goes in there. It's a totally different bank. I have I don't touch it unless I make a conscious effort to use it. And so that's what you could do with that extra money, is set it aside so that you're not using it to pay off your debt. So you set it aside in order to pay off your debt, because it might be for some people advantageous to have a large sum of money to pay off the debt. That would be really nice. If you think about it, 20 bucks a month, save that up and then pay down $100 in addition to your minimum payment on one of your credit cards. You'll get it paid off really quickly. Ask for lower interest rates. This sometimes I always, even personally, I'm like, yeah, right. Asking for lower interest rates doesn't hurt. Some companies will be willing to negotiate your interest rate with you, and the catch is you just have to ask. It doesn't hurt to ask. What are they going to say? No. They could say yes. They could look at your credit report, your credit history, your credit score, how you've been paying your loan with them, how you've been paying your credit card with them, whatever it is, and they might be able to work with you and give you a lower interest rate. I always think not only can you ask for lower interest rates, but what about refinancing your car? This is something, and well, now the place I have my car with, I really like them. I use them pretty frequently when I need to buy a new car, and they always have the lowest interest rates. But we had refinanced a vehicle to this bank from our other bank because they had a lower interest rate and saved a lot of money. So, and now they just have my business probably for a really long time because I like using them when I buy cars. So that's another thing you can do, is refinance. That'll get you a lower interest rate. Now moving ahead to, and if you have any questions, just let me know, but moving ahead to building wealth, I want to know if you have any financial goals. And that might sound like, oh, who doesn't have financial goals? But maybe you haven't thought about it. Maybe you don't have any. Maybe you don't realize what your financial goals are, in the sense that we would like to put a new deck on the back porch, or, I don't need a new ceiling fan. I have a perfectly good working light above my dining table, but a new ceiling fan is not cheap, depending on what you want to buy, and then the time it takes to install it and this and that. And so that's something that's actually on my financial goals list. And it looks like pretty much everyone today does have some kind of financial goal, and some of you haven't even thought about it. Someone asked today, is it a good idea to use credit cards to buy groceries or pay bills to get miles, as long as you pay? See, there's the catch. As long as you're able to pay it off each month. The only thing is I would set an amount of how much here's what I would do. I would budget the amount that you're going to spend on your credit card every month, because if you build your budget and let's say you also build your budget with miscellaneous expenses such as unforeseen medical cost, unforeseen pet cost, home repairs. So you've got stuff budgeted aside for that, because the only catch, and it's good for building your credit that way, is to make a small purchase every month and pay it off every month. I will say that if you swipe for 2 tanks of gasoline each month, but you pay it off the following month, that is a pretty good idea. And he talks about getting miles. People say miles, points, rewards, cash back, those things. Yes, that doesn't hurt. But the catch to the question is if you're able to pay it off. So what I would do, if you want to do something like that, if you want to use your credit card every month to help build your credit history, maybe you just have a favorite credit card that you like because it's got a great interest rate, it's got great rewards. That doesn't hurt, but I would budget that money. So let's just say, okay, I know that I shouldn't spend any less than $100 a month on my credit card, because I know that in my budget, I have that budgeted that I can pay it when I get paid. And so that is something that you should consider. So if you are using a credit card once a month to establish, your credit, to establish credit history, budget that expense into your budget every month. Okay. I have another question. I've been told that refinancing, although it can bring down your interest rate, it resets the length of your loan, and refinancing ages. Okay, so yes, there is the catch. It does reset your loan. I've done it because I wanted the lower interest rate. And so even though it resets your loan, let's say you have a 5-year loan, but a high interest rate. Well, if you refinance with someone else, I would also say you don't want to refinance when you only have a year left in that loan either. If you're thinking about refinancing your car loan and you only have like maybe a year left to pay it off or 2 years left to pay, I would probably first approach the place that you have the car with and ask them about lowering your interest rate. Say, look, I paid it on time. I've done great. There are lower interest rates here. I've been shopping around. Show them those interest rates and see if they're willing to work with you to bring your interest rate down. Because that is true, it does reset your loan unless you refinance. It depends on what you refinance for. Let's say you have your original loan is a 5-year loan and a higher interest rate. Let's say you go to X bank and you refinance for a lower interest rate, but you could do a 3-year loan, because if you can afford what you were paying at the higher interest rate over the longer time, and you could afford to continue paying that at a lower interest rate for a less amount of time, then you would get the loan paid off faster. So see what you could kind of do there? You get the lower interest rate, and it also typically most places aren't going to, there's not prepayment penalties. A lot of places don't do that because paying it off, they're still getting your money. You know what I mean? They're getting less interest, but they're still getting your money. So that's another thing when you refinance, when you're getting car loans, you want to look at prepayment penalties and make sure there's nothing out there that's going to hurt you if you do get it paid off early. So yes, it will extend the life of the loan depending on what you sign up for. So that's one of the catches when it comes to refinancing. Is canceling an unused credit card a bad idea or a good one? You're welcome, by the way. So is it a good idea or a bad one? So I want to say yes and no. A lot of places, a lot of people will say, oh yes, don't cancel it. It looks bad. But personally, I have a very long credit history. So maybe that's a catch. I do have a long credit history. I personally have good credit. It's one of my financial obsessions is to monitor and track my credit, probably a little obsessively. But if you've got a whole bunch of accounts open and you've got some cards that are just sitting around and you haven't used them in a really long time and the company hasn't closed them, because that's another thing that will happen a lot, is the company will close your credit card for lack of use. And so it doesn't, if you still have like 2 or 3 credit cards you do use regularly, closing down the ones that you haven't touched in ages, it shouldn't affect you when it comes, because another thing that so here's the catch. Some people say yes, some people will say no. I say go ahead and close them if you're not using them, because here's another thing. Let's say you went out to look for a new home and you want to get a mortgage. When you apply for that mortgage, the lender looks at your credit report, your credit file. Let's say they see one working visa, and I say working because it has a debt on it. You are paying it off every month. You're doing whatever it is to, it's good. It's a good card. But then they see 2 Home Depot cards, a Lowe's card, a Kohl's card, XYZ retail store cards everywhere. You've got like tons of credit cards, no balances. But the problem is they have the potential to have balances. So when I know that when I went and got my mortgage on my own, the lender kind of red flagged that in the sense that, ooh, and I was told both times, you're buying that new house, you're like, oh, I'm going to need a new refrigerator, I'm going to need a new dishwasher and dryer and washing machine, I'm going to need all these appliances, all this furniture. Whatever you do, that is the last thing you do. You do not rack up your credit right before you're about to close on a mortgage, because you can be denied at the 11th hour, because they now see that your debt to income ratio has far exceeded and you're about to take on a mortgage. So personally, I have closed cards that I don't use because I wasn't using them, and I still have active credit cards, things that I'm using frequently to help my credit history, to help my credit score, things that keep it moving along. And so as long as you've got a couple or even just one credit card that you do use frequently, that you do put, for instance, maybe you put some groceries, a tank of gas on once a month and you pay it off every month, closing those other little cards shouldn't affect you as much. But I definitely wouldn't close them all at once either. I wouldn't do that. Maybe go through, look at how long they've been sitting there, check the interest rate, see if it's something you really don't want, and close it and call it a day. So what does building wealth mean to you? And this section isn't very long. It's just kind of get those gears working, kind of get you thinking about what wealth is. Is it having money in your pocket? Is it having the big fancy house? Oh, and we are right at 11 o'clock, you guys. This has been a great morning. If you need to log off, it's 11 o'clock. If you need to go do something else, go ahead. I'm going to go over building wealth right now. If you have any questions that you want to email me offline, if you need to go, you can email financial-education@occc.texas.gov. I do webinars every Thursday at 10 o'clock. And today we've had a lot of questions, so that's why we've definitely run into the 11 o'clock hour. So go ahead. If you need to go, I won't hold you to it, okay? So what does building wealth mean to you? Building wealth is your assets, your liabilities, and what equals your net worth. So what you're going to do is your assets is anything that you or a business owns that has commercial or exchange value. Your liabilities is any money and you or an organization owes that's the same as debt. And the difference between the total is your net worth. And I always think, well, what do I have? What kind of net worth do I have? Well, here is what a balance sheet will look like. So you see your assets at the top, your liabilities down below, and your net worth. When we purchased our last home, one of the stipulations was we had to pay off a car from the proceeds of our last house. And so we paid off that vehicle immediately. And it's in great shape. So I have an asset, a clear asset. I have the title, it's my car, good to go. So that is something that is an asset to me, because when I look at this, I go, well, I don't have any assets. I don't have any assets. I have a lot of liabilities, like a mortgage. Someone said they got their 3 free credit reports at annualcreditreport.com. Thank you. And then you have your net worth. Now, when it comes to building wealth and your financial outlook, you want to set goals. There's short-term goals, intermediate goals, and long-term goals. Short-term goals are less than a year, like a savings account. Intermediate goals, maybe a down payment on a vehicle. And long-term goals take a little bit longer. So you want to budget and you want to add your goals, and you can build wealth. And this also will help you with your financial picture. This is big when it comes to your finances, and we're almost done. We're on the home stretch here. And this one is really important to me, though. You want to achieve your financial goals. And this goes back to those New Year's resolutions that we talked about, achieving your New Year's resolutions, preparing, setting goals, managing your goals, and communicating your goals. You want to write down your goals and make them visible and be specific and achievable. There you hear that word again, achievable. Last time I did budgeting, we talked about financial goals, and someone said that their goal was to pay off some credit cards this year. That's a great goal. That's going to increase your credit, and it's going to be wonderful. How much will it cost? Not just the money that it's going to cost you, but consider your support system and necessary sacrifices. I mentioned that I need to budget putting in a ceiling fan. So the ceiling fan is going to cost me financially, but it's going to cost me and my husband time as a couple to install the ceiling fan. And seeing as I am very short, it's going to be a struggle. And there's going to be quite some sacrifices there. You want to communicate your financial goals. You want to rank them and share them with your family members. For instance, we would like to put a new deck on the back porch. That's a big financial goal. And so that's on our list of things to do. And we work towards that goal. We both would enjoy having a new deck on the back of the house. And so it's important that we see those and we share those with each other. You want to establish a timeline. And this affects your budget, which I included the budgeting worksheet today. If your goal is to save $1,000 for a down payment on a new car over the next 18 months, you're going to need to set aside $56 a month. Think about that, $56 a month. Let's say you're eating out like twice a week even. If you are like me, a family of 4, eating out twice a week will cost you more than $56. So that's just cutting out twice a week eating. And you could have a down payment for a car. You could also be putting that money in a savings account. You could be putting that money towards your debt and paying it off. You need to be flexible and keep your eye on the prize. You may have to reset or compromise, and there's going to be setbacks. For instance, last year we had some unforeseen problems with our aging pets. And so that took a big chunk out of our financial goals that we had, because we had to allocate money from our savings in order to take care of our pets, which of course we don't regret doing that because, we love them, but don't beat yourself up. If you're already facing a hardship like that, don't add to the problem by stressing yourself out over the money. And some of the things I want you to remember today, that if you build your credit, you work on your credit, you have good credit, you're going to have consumer confidence. It makes a world of difference when you go to buy a new car and you know what you can afford and you know what you want, and it's not the other person telling you, oh, let's go see. You know what you want, you know what you can do, so you do it. When you have good credit, it helps you save money and it helps you to possibly get lower interest rates. It helps heal your credit score. So as you're working towards your budget, as long as you're working on your credit, you're checking your credit report, you're going to help that credit score go up, hopefully. It saves yourself some time and stress. So that's good. Who doesn't want more time and less stress? And it helps you take control of your finances. That's a big one. We all want to be in control of our finances because you know what you can and cannot do and where you can and cannot go and how you're going to get there. And so all of those things work into your New Year's resolutions. Maybe it is, finances this year. Maybe it's losing weight. Maybe it's exercising more. All of those things will kind of come together and help you have a clearer picture of things. Now I'm going to wrap it up today. Sorry we ran a little long, had a lot of great questions. Again, my name is Andrea Johnson. I'm the Financial Education Coordinator for the Office of Consumer Credit Commissioner. You can email me at financial-education@occc.texas.gov. You can also follow us at Texas Financial Education Endowment on Facebook, so like our Facebook page, or follow us at Financial Ed Texas on Twitter. I'd really appreciate it. And I hope everyone has a great day. And, just take a little time to think about your financial goals and where you want to be. And I hope this webinar helped you today. Bye, everyone.